So if the year has ended, but the transaction has taken place, which is a non-adjusting event in nature, however, it affects the going concern of the entity, then possibly the entity must prepare the financial statement on a breakup basis, not on a going concern basis. And we're going to be clarifying this in a moment as we dive deeper into the discussion. So that is the concept, that is the general idea about events after the reporting period. Remember, it is the transactions taking place between the year end and the day that transactions are authorized for publication. These transactions occurring can be divided into adjusting events and non-adjusting events. The variables we use by default on categorizing these events is whether it is providing further information on a transaction that existed at the reporting date. If it is providing further information, thumbs up, adjusting events. If it is not providing any further information, thumbs down, non-adjusting events. If the transaction is affecting the going concern of the entity, hell yes, then we going to adjust it, even though it may by default be an adjusting and non-adjusting event. That is the idea about this. But let's dive a little bit deeper. What are some events that can be considered as providing further information, and what are some other events that can be considered as non-adjusting events? So let's dive deeper a little bit into my slide here. So, like I mentioned to you, for one-liner definition for my secretaries and people who like to write, we say that adjusting events, like we said, events that are providing further evidence of conditions that existed at the reporting date. Non-adjusting events doesn't provide anything to us. They are just things that are happening after the reporting date. So let's look at a couple of examples here. Stay with me very carefully. Information relating to a condition that existed at the reporting date. Settlement of an outstanding law case. What does that mean? It means that, for instance, prior to the year end, remember, let's say our year end is 30th April. So prior to the 30th April, we were in court. There was a court case, but judgment had not been given. Now, remember, in accordance with IAS 37, if there is a scenario like that and there is a pending court case to which judgment has not been given, it depends on where the entity is standing. We may have to make a provision for contingent liability if we are going to be the ones to make the payment, or contingent asset if we are the entity likely to receive the money. There are criteria about this. We will talk about this later on. But once the court case is pending and judgment has not been given, IAS 37 requires that at the reporting date, if the entity is the one going to be making some payment and it is virtually certain that we will make the payment, then we have to make provision for contingent liability. Then, if we are the ones going to be receiving something, IAS 37 states that then we have to recognize contingent assets. That is the requirement. So at the year end, the judgment had not been given. So probably we made a provision for contingent liability for, say, $100 million. We think that is what we're going to pay. Then immediately after the year end, judgment was given. Maybe a month after the year end, judgment has been given. Okay, if judgment is given, now we know how much we are supposed to pay. So when judgment was given, maybe the judge ruled that we are liable to pay $90 million. What does that mean? It means that we had overcharged that, because a reduction in provision is a gain. So we would have to go and recognize income in the P&L account and de-recognize the liability that has been on the face of the statement of financial position, because the case has been settled. That is the issue about settlement of outstanding court case. I hope you are following the idea. I see some of you guys joining. You are welcome. Give us a thumbs up on the video. It really helps us a lot. Consider to also share the video. Let's reach as many students as possible watching this live streams. But most importantly, let me hear from you in the comment section, in the chat box. Any questions you have for me, put it in the comment section. Something you want me to share my thought on, don't hesitate. Want to hear from you. Next one, bankruptcy of a customer. Ooh, bankruptcy of a customer. Again, if you remember very well, the prudence concept. Okay, the prudence concept. The prudence or conservative concept simply states that an accountant or an entity is required to make provision for future losses, but cannot make provision for future gains. In other words, when someone is owing the entity, it is prudent that the entity assesses at the reporting date whether it is certain that all the amount of money will be received. Where the entity is in doubt on the likelihood of the receipt of all the amount of money, the prudence concept allows that the entity will make provision for bad debts. Okay? We make the provision for bad debt. So maybe we made a provision for bad debt and say, okay, this particular debt, there is a customer owing us $10 million. So we have made provision for bad debt of maybe 10%. So it means we have recognized in our books that, oh, we will receive only 9 million from this particular customer. Then 1 month after the reporting date, this customer has filed for bankruptcy. Wow. If the customer files for bankruptcy, then we are not likely to receive all the amount of money. So it means that we would have to then go and check with the administrator of the assets of the customer and find out how much of this 10 million can we actually received. How much can we actually receive? Sorry. It means that we would have to then increase our provision from the 10% to probably maybe 80%, because maybe the administrator of the assets of the defunct firm will say, hey, you are likely to get just $2 million from your $10 million because the company has no assets available. That is what we mean by bankruptcy. So you realize that the idea here is that you see that all the adjusting events have connection with something that existed at the reporting date, and we are applying the accounting standards and the accounting concepts. Sale of inventory at below cost. Sale of inventory at below cost. Now, if you remember again, in accordance with IAS 2, inventory should be valued at what? Lower of cost and net realizable value. Now, as at the reporting date, it is required that an entity will estimate the net realizable value of the assets of inventories. But sometimes it is impossible to accurately measure the net realizable value of inventories. It is not accurate usually. So what is going to be happening is that if immediately after the reporting date, an inventory that had cost $10 million is now being sold for, say, $8.5 million, then it tells us that really the net realizable value of the inventory is $8.5 million, which is below the cost. But remember, in our books, we have recognized it at $10 million. It means as at the reporting date, the entity has overstated its closing inventories. So it's an adjusting event. We would have to go back and go and charge impairment in the inventory, which will go to the P&L account for $1.5 million. Are you getting the idea here? That is the third scenario here. Sale of inventory at below cost.